All right, well, might as well get started here. Thanks everyone for joining us for this week's community call. Our guests today are Brave New DeFi from Flat Money and Armin, is that how you pronounce that? From DHedge.
Yeah. Oh, Ermin. Yeah, that's fine.
Armin. These are two lovely protocols that we've, in various ways, been partnering with over the past couple months, which we will get into later on. But why don't you guys introduce yourselves and give a little background about yourselves and the protocols you're here to talk about?
Yeah, I can kick things off. My name is Brave New DeFi, and I work over with the Flat Money team. I work alongside Ermin, and we are building a protocol where people can create on-chain money that's uncensorable, inflation-resistant, and backed by decentralized collateral. That decentralized collateral happens to be our ETH. So we've been working to create a delta-neutral flat coin on Base. And we are getting pretty close to our launch, but I will let Ermin talk a little bit more about the protocol, and we can kind of play off of each other as well.
Yeah, sure. So yeah, I'm Ermin. I'm also working on Flat Money. As you can see by my tag here, I'm also working on DHedge. And DHedge is a on-chain asset management protocol, or doing decentralized vaults. And yeah, we just saw this opportunity to build better money, and kind of that's where Flat Money came from, and that's how we got to here today. So happy to dive into the protocol, why we decided to build on rETH as well.
Yeah, let's talk about it. So, Flat Money Protocol is what seems to me a two-in-one product where you have Unit, which is the stablecoin for the protocol, and then you have a set of applications built around that in-house, such as perpetuals. So let's start with the stablecoin. What is Unit and how does it work?
So I'll start off by correcting and saying that Unit is actually it's a flat coin. So a little bit different.
Correct. Big, big,
Yeah,
big difference. Let's
yeah.
start with
So
that. Yeah.
little bit different than a stable coin. So a flat coin, for those who aren't familiar, is a coin that's designed to keep your purchasing power flat. Not the greatest name in products. We're not always the greatest at naming things, but that's the asset class that it fits into. And flat coins have kind of come to prominence here within the last couple of years. Brian Armstrong of Coinbase has talked pretty extensively about flat coins, and it's an emerging asset class. So when we saw this opportunity to create better money, we kind of looked at the landscape and saw a lot of these stable coins. And I mean, as most people know, like 96% of the stablecoin market is centralized stable coins. So we saw this opportunity to build what kind of harkens back to like actual internet cash, right? Internet money. Something that people talked a lot about in the 90s during the dot-com boom. And some of the early days, this was like the catalyst behind, originally PayPal and some of these things. So we didn't really see any of this like internet money being delivered on until Bitcoin came around. And of course, with Ethereum, we have all of these different ways that we can build different protocols on top of the EVM network. And what we were looking at is trying to create a flat coin that has intrinsic yield. So flat coins are designed to outpace inflation. They're designed to be censorship resistant, and they should have decentralized collateral backing them. So some people do different things. Some people will take a flat coin and they'll basically start at $1 and it'll be kind of pegged to CPI. What we've done is we've taken the flat coin model, but we've created this delta neutral marketplace. And so it's a two-sided marketplace. On one side, you have the flat money unit market, where somebody can deposit rETH and they mint units. On the other side is a perpetual futures market for rETH, where somebody can deposit rETH as margin collateral, and then they can open a long position on rETH. So between those two markets, you get that delta neutral position, and there's incentives between the two markets that rebalance, which is essentially what the funding rate, which we call the borrow rate, does. When there is not a lot of leverage being taken out, that funding rate will drop to be competitive with other markets. And when there's a lot of demand for leverage and there's less supply on the unit side for rETH liquidity for leverage traders to borrow, then that funding rate is going to creep up, which creates an incentive for people to mint and hold unit. And so when you're holding units, you have this flat coin that earns trading fees from the perpetual futures market. Any liquidations, it's going to earn fees from that. And then, of course, it's going to earn the funding rate fee when the funding rate is positive. So as a unit holder, you're effectively short rETH. But the long-term view when you're holding unit is if you think that ETH is going to be successful in the long term, but it's going to be very volatile in the short to medium term, and that volatility is going to be more profitable in the longer term, then holding unit is a pretty good bet, especially if you have an ETH heavy portfolio. That's my personal view. So that's how the protocol is set up on a very basic level. I can let Ermin jump in and talk about some technicals and some specifics on it. But that's the basic idea behind flat money. It's this delta neutral marketplace where everything is combined it's confined to those two markets. There's no external dependencies. There's no other protocols that we're integrated with. Really, the only outside exposure we have is to Pyth and Chainlink oracles that we use within the protocol, and then of course to rETH as the collateral that's backing unit and acts as liquidity for the perpetual futures marketplace. Otherwise, everything is just isolated within the protocol. So I'm trying to keep things as simple and as safe as possible to build better decentralized money on chain.
Super cool. That was a very thorough explanation. Armin, do you have anything to add?
Yeah, that was. I think that's covered a lot of points. So yeah, like in summary, it's fully backed by rETH. Once you deposit into unit the flat coin, it basically once you deposit your rETH into it, it strips out the volatility. So if the price of ETH goes down, you don't ride that volatility down. You end up rETH if when you withdraw. But vice versa as well. So you strip out the volatility, but as Brave New DeFi mentioned, you're earning yield, and that yield is generated by this rETH perps market on the other side, where you basically have leverage traders that are taking on more volatility. So you got leverage traders taking volatility, paying a funding rate or a borrow rate, as we call it, and as we know, that's quite profitable today. But on top of that, there are no costs to the unit holders to be able to delta hedge. It's all kind of done via these kind of incentives within the protocol itself. But if anything, the delta hedge, it's the other way around, where the unit holders are actually earning to be hedged by leverage traders. So as Brave New DeFi said, like all the leverage trader trading fees or liquidations, all of that comes through as fees to the unit holders. And maybe to touch on like why we think kind of this is important. Happy to dive into that as well. So I mean for me personally, stable coins today, which are essentially just on-chain US dollars, it's obviously it is an important key factor to kick off DeFi in the early stages, because people just didn't want to ride the volatility of crypto. They wanted to be able to escape it while staying on chain, and that's been good. But at the same time, the leading stable coins today, it's essentially just US dollars, treasuries, these types of off-chain derivatives held in banks. When one bank, as we've seen with USDC last year, one bank, sneezes, you see a DPEG,
Right.
and right, and it's like all of a sudden DeFi, there's a risk to DeFi, and it's like, well, this is supposed to be decentralized finance. Why are we increasingly tying ourselves to these off-chain risks? And then on top of that, it's like these assets, and some people are predicting, the value of stable coins on chain to sort of increase or even go 10x from here. And then you kind of go, well, okay, you're settling more and more, on chain, that's assets that are tied to legacy financial systems that are deeply integrated, more increasingly integrated into DeFi. And on top of that, it's not even kind of helping secure the Ethereum network. So what we wanted to do is, pick the best collateral that we can to build this on. And we all think that the rocket pool ethos is really up there to kind of not scale at all costs, but to kind of scale for the future, if you know what I mean. And I think that's clear from the community here in Discord, as well as the in-person events like the Liftoff event in Denver. And I think that alignment, we really truly believe that alignment makes a lot of sense, to build money that's not only going to kind of be the best money in terms of, say, yield, but also to be resistant to kind of these shocks that we've seen in the past with stablecoins.
Yeah, that makes a lot of sense, and I think that's a good transition into my next question, which is, how does flat money compare itself to the world of existing stablecoins slash flat coins slash perpetual options? So it's very distinct from a USDC, as you just made clear. USDC carries all these custodial risks, though it might hold a pretty strong peg to the US dollar. Something like Rye is free floating and also based on a borrow rate, but doesn't have the built-in market around it. It seems like, and then there's also options like Synthetics is stable SUSDE, or sorry SUSD, and then Athena's new semi-centralized derivatives based token. So yeah, like how does flat money compare? What are its advantages, strengths over the rivals?
I'll cover the stablecoin, flat coin, other asset part of the question, and then I'll hand the perpetuals side off to Ermin. But for a lot of what we've seen, stablecoin side, right? You have your centralized stablecoins. You have some of these attempts at a decentralized stablecoin, which has primarily been like pure ETH backed. Liquid EV2, of course, is coming out, and they have a different model, which I'm excited to see. But Rye was one of the early stable coins that I was really excited about. But all of these things have used a CDP model that is kind of akin to the early days of MakerDAO. And so one of the big distinct differences with flat money is it's not a CDP model. It's a little bit different to wrap your head around when you're so used to thinking of like the CDP model. But when you deposit in rETH and you mint units, the value underneath is not subject to like a liquidation like you see with a traditional stablecoin or a CDP setup. So when you put in rETH, the ETH value underneath unit can change, depending on market movements in the short term. But most people are denominating their assets in USD terms. So the goal for this is to earn fees over time from that volatility from the perpetual futures market side and grow in value over time. So you're earning all of those different fees, and that allows you to grow your value in USD over time. The value in ETH terms can grow over time as well, but it's probably going to change a little bit depending on market fluctuations. But again, in the long term, you're looking at something that is benefiting from all of those trading fees. One of the other distinct differences is when you're looking at something like Liquidity or Rye or Maker or Aave, if you're looking at somewhere where you're going to mint a stable coin, there's some level of over collateralization, right? Because there is a liquidation point that happens. So with the unit side, when you put rETH in, because the underlying value can fluctuate, there is no liquidation. It's 100% collateralized by the rETH underneath. So it's capital efficient in the sense that the backing behind it is always going to be there, and it's also used to lend out to the perpetual futures market side. So it's a little bit different than existing models, but we think that this is something that's more scalable, and something that can benefit holders long term because it's going to grow in USD terms over time. So I think those are some of the big distinct differences. I know a lot of people have compared flat money to Athena. I will say that Athena isn't a semi-centralized synthetic dollar. It is just a centralized synthetic dollar.
Very
Um,
true.
but I think one of the key differences to that one is that when you deposit rETH and you mint unit, you're earning yield. You don't need to stake anything. Like if you hold unit, every unit holder is earning yield. There's no gamification where we say, well, you have to stake to get the yield. Everybody gets the yield if they hold unit. So that's a big difference. The other one is that we're decentralized. We have the perpetual future market on the other side that's running, and that's where all the fees are coming from. So while Athena is running their trade and they're earning the funding rate fees, we're earning the trading fees, liquidation fees, and funding rate fees, and those are all going back to unit holders. So I think on the stablecoin, flatcoin side, that's the big difference. There's not a lot of projects that have done what we're doing in the same way that we're doing it. No one's kind of baked in their own perpetual futures market into the protocol. For a lot of other flat coins, are basically tying things to, the CPI and everything, or they're offering some growth incentive using real world assets like US Treasuries. So having decentralized backing, having value growth over time are two very important things. And so it's a little bit of a different model, but I'll pass things off to Ermin to fill in any gaps and talk about the perpetual side.
Yeah, I might cover some of that area as well. I totally agree with you. In terms of Athena, it's essentially a fund that's been tokenized, and I think that's fine. That's okay. But in terms of how people think about it or marketing side, it can be misleading, and I think that's just the problem in the space in general. So the risks are not necessarily clear there. In terms of comparing I'll say the other thing that happens now in the space, maybe this is like PTSD from like Terra Luna days, is whenever there's a new type of low volatility or stable like asset or a new type of asset class, people tend to compare it to kind of algo stable coins of the past, and as Brave New DeFi's kind of said, it's just not the case here. So for one, it's like a lot of those assets were kind of under collateralized or not really collateralized at all, or there was kind of this feedback loop where the collateral was kind of the native asset tied to the protocol itself, which can kind of lead to really fast growth, but also super fast kind of decline. So what you want is you really want the best collateral you can kind of use to back it, and you want to back it 100%. You don't necessarily want to back it, over collateralize it if you can do that. So with the CDP model, like the original MakerDAO or Liquidity, you had to back it with say ETH, which is fine, but you have to over collateralize it because when the price goes down, your position can get liquidated. And again, this is like good in the bull market, but not so good in the bear. And and as a result, what we've seen from MakerDAO is they've kind of made this pivot to not focus on this decentralization ethos, but go with real world assets and just try and kind of capture yield and revenue there, which is also fine, but as long as that's kind of clear and transparent. So for us, this is like 100% backed by rETH, and it's a delta neutral strategy, and it should yield even better than the basis trade that we're kind of hearing about now, because the leverage side is also built into the protocol, which means flat money doesn't need to go to some external perps exchange or take external risks. Everything is tied and built directly into the protocol, which means all of those yields, all of that kind of revenue that the regular kind of perps exchange would earn would go directly to unit holders as yield. So that's additional yield to the regular basis trade.
Yeah.
Go ahead.
So the unit token passively earns yield from 3 different sources: the liquidations, trading fees, and then the perpetual borrower rate.
Exactly, that's right.
So in the ideal world for the unit holders, the demand for leverage is high, the borrow rate is high, and they're earning quite a juicy APR passively, with fairly little risk of unit having any dramatic fluctuations from its current price. However, in adverse events, what do you expect to happen if, let's say, there's a crunch on capital and liquidity needs to exit the system, and at the same time, funding rates start to swing. Given this is all an internal system, we don't have to worry about like a middleman losing any money or in a bank anywhere. But just internally, like still, what can happen to the value of unit? And any other consequences for unit holders if TVL was to start having a sudden outflow.
Yeah, for sure. So let's say the market turns, say the price of ETH is going down for whatever reason, right? Or it's just a general bear market. So what can happen is, the funding rate can go the other way around, where instead of unit holders earning that funding or borrow rate, it's actually the other way around, and they need to pay to make sure that there are enough leveraged traders on the other side to hedge the volatility of rETH for unit holders. So in that scenario, still the unit holders will still earn the trading fees or liquidations from leverage traders. In a regular basis trade, you're always paying to do that, but for unit, you're actually earning that. So that should offset some of the funding rate kind of concerns. But essentially, at the end of the day, as mentioned, it's the full system. Both sides are just backed 100% by rETH. So leverage traders can close their positions. The unit holders are able to withdraw. That collateral is always there and it's always on chain in the smart contracts.
Do you think there's any risk added through the Chainlink or Pyth oracles, or is there extra security around the system to prevent any oracle attacks?
Yeah, that's great. So in terms of external dependency, it's like there's literally only really two. We're talking about rETH, which is the reason why we picked rETH was because we see it as being the most robust LST, and the other one is the oracles for rETH. So the protocol uses, as you mentioned, both Pyth and Chainlink. And what it does is it also uses kind of Chainlink as a bit of a sanity check, just to make sure that the Pyth Oracle price is kind of returning the right value. It hasn't kind of gone off the rails. Certainly, if the oracles did go down, then that is a problem for sure. But we're using redundancy there, and we're also looking to add more oracle sources for rETH.
Yeah, the redundancy makes a lot of sense because rETH, given just its nature, is very reliably going to be near peg, like plus or minus, honestly, like a couple of percent ever. So had it have a large swing in the data feed, it makes sense that something might be wrong. So redundancy, definitely something useful.
Yeah, for sure. So yeah, I think the leverage side, the perps market for rETH, I'm sure it's literally, it might be the only place in DeFi where you can just leverage long rETH. And what I'll say with that is that you obviously are leverage longing the ETH volatility, but you're also multiplying, depending on your leverage, the staking yield underneath. So that's the additional benefit. So you just come in with your rETH. You can say, how much you want to put in, say 1 rETH, 2x leverage, and you've got that leverage exposure to not just the ETH volatility, but also the staking yield also.
That's right. And I believe there will be an initial $2.5 million worth of rETH liquidity. So initial borrow rates will probably be fairly competitive compared to the wider market. And I think on base, there is no wider market.
Yeah, Brad can talk about this as well, I guess. But yeah, we're going at this initial phase. So there was an early depositor vault, which was shared with the community here, and the initial deployment of those funds will be about I'd say about 1,000 rETH on both sides of the market.
That's pretty awesome. That's a pretty healthy Kickstarter market. Let's talk a little.
For sure. Yeah.
Let's talk a little bit about base, because that's where flat money is going to be, right?
Yeah, that's right. Yep.
So walk us through like how did that decision go? Like why base?
Yeah, so I don't know, Brave, do you want to talk about it? I'm happy to take it as well.
Yeah. I think one thing I wanted to touch on real quick about the funding rate. So the funding rate in the perpetual futures market is going to be competitive, but there's also going to be FMP incentives for early active leverage traders, and we have that outlined in one of our blog posts. We have a building better money series that we have on the Flat Money blog. So if anybody wants to read about those incentives, they can find that there. But yeah, the decision to launch on Base. So I think there's some core decisions. One of them is looking for any kind of perps market. You basically need to be on an L2 because anybody that's opening leverage positions or is participating in a perpetuals market, they're going to want those low trading fees. So we definitely wanted to look for an L2 where we could build. I think with Base in particular, there are two main things. One is that Base is onboarding a lot of users. There's a lot of activity on Base. But the other one is that we are a specialty perpetuals market, right? So it's kind of just limited to rETH, and in the future we can have other LST collateral. But with synthetics launching Andromeda on Base, you also have a wider perpetuals market. So between those two, there's going to be some abilities for leverage traders to hedge their positions on synthetics if they'd like to, but there'll be funding rate arbitrage between those two protocols. And so that'll be both beneficial for flat money and synthetics and beneficial for leverage traders participating on Base. So we know that there's already an audience for leverage traders on Base. We know that there's a lot of new users coming in, and we're building better money for the masses. And we thought there's no better place to do that than Base, with a lot of the incentives and a lot of the excitement around what's happening on Base. I think that Base has been relatively active. I think meme coins have kind of increased some of the gas fees, but over time that'll come down and it'll be a really competitive place to build a new primitive compared to some of the other markets. Like Optimism's great, Arbitrum's great, some of these other ones, but we thought Base was the best choice for the audience and for the use case that we were building.
I'm glad you bring up synthetics, because I was reading that the D-Hedge vaults are a potential future release in which, as you said, you can have a hedged arbitrage between the synthetics and flat money rates, which is pretty cool. I'm a big fan of synthetics. SUSD is a pretty good asset, but it's not a money that's suitable for the masses, given it's a fairly complex relationship to the overall protocol, which is, I think, a great place for flat money to fit in, providing that very strict uh, uh, slice of the overall market in a very resilient way.
Yeah, absolutely.
Yeah.
I think I'll let Ermin jump in too, but one thing I wanted to fill in is that there really aren't any perpetual markets for any kind of liquid staking tokens. So building flat money is kind of like, it's the first that I'm aware of, it's the first rETH perpetual futures market. So again, it's more of like a niche leverage market, but it'll benefit between having those two perpetual markets on Base. So again, there's going to be an audience of traders active on Base already. And yeah, I'll let Ermin talk more about the ability to build within the hedge family and kind of create some different vaults that can arbitrage rates between the two as well, and kind of integrate more into the flat money ecosystem.
Yeah, the other thing I wanted to add was so unit is obviously a yield bearing, low volatility asset. So what that means is it makes it a really good collateral to be used within DeFi. So let's say, if you're a synthetics user and you'd like to either LP or you'd like to sort of open a perps position on synthetics. So on Andromeda, they're using USDC at the moment on Base. So what that means is, you're depositing your USDC, say as an LP, but that USDC is kind of there to back the system, but it's not inherently earning yield. So a decentralized yield bearing asset would make much better collateral. Likewise, if that's used as margin for your perps, you could have a regular kind of stable coin that's going down with inflation over time, or you could have an inflation-resistant decentralized asset instead. So having collateral, low volatility collateral, we think is really important within DeFi, and one that is also, essentially rug-proof and decentralized. So Coinbase and Base really understand that, and it is within their ethos, which is why they call it out as kind of the number one thing, as a request for builders.
Oh, that's great to hear. The base team has been super active promoting all the protocols that are building on top of it. Let's talk about how Rocket Pool and Flat Money have been teaming up to boost rETH liquidity on Base. This program has started a few months ago now, with incentives coming from both the IMC and from Flat Money towards Balancer, and then additional incentives from the Flat Money team focusing on Aerodrome. Is that right?
Yeah, absolutely. I started working with the IMC in January, and just an initial discussion to get familiar with the IMC and talk a little bit about boosting liquidity initially in the balancer pool. So when we started, I think there was around like 1 million in TVL. It would be really nice if balancer showed things in ETH terms, but that's what it was. It was 1 million in TVL, and now it's at about 1.62 million in TVL. So we've grown it quite a bit. I think the other thing is, if I remember right, it was around like 198 or 200 rETH that was in that pool. And now there's 336 rETH in the balancer pool. So we've grown that roughly 60% from where it was. And we also worked with Beefy to get the balancer vaults as a Beefy vault for people that wanted to deposit and have those rewards auto compound back into their LP positions. And then in
Which
March,
is huge, by the way. I love beefy vaults. They make life so much better.
I love Beefy vaults too. So I was like, I would like to LP in this, and I would like to use Beefy. So,
Exactly.
and they're great. And I was like, can you make a Beefy vault? And then they're like, done. Like the next day, they're like, done. We did it. And I was like, thank you. But yeah, and then in March, we also seeded and began providing incentives to the Aerodrome rETH WETH pool as well. And so that's grown to 136 or 1.36 million in deposits. So that's grown as well. I know at its peak it was like over 2 million in deposits and everything, but I think with the growth of the Aero token, things went up and it's fluctuated. So right now in total across both those pools, there's about 3 million in liquidity, and I think the yield on the balancer pool is around 11% through the Beefy Vault, and through the Beefy Vault for the Aerodrome pool, it's around 14 to 15% last I checked.
Wow.
So decent yields for rETH LPs, and a lot more liquidity on Base than there was when we got started, which has been important for us for that Flat Money Early Depositors Vault.
I would love for rETH to grow right alongside of Base, and it's been a huge help, the Flat Money team providing incentives that we've been able to match on the IMC to grow it as the hype builds on the meme coins. Hopefully, at least some of those traders are smart enough to take profits towards an LST for the long haul. It would be awesome if rETH was that token. So, building up rETH's reputation through Unit as becoming a decentralized backbone of the base economy, brings us all into like a beautiful harmony.
Yeah, absolutely. That's our goal. We definitely want to scale Unit. We want to do it responsibly over time, but like Ermin said, like we looked at the different options, and initially we were going to go with staked ETH because that's all that we saw other than Coinbase ETH that was on Base. And then I had spotted that I was like I think it was the day after I saw the announcement that rETH was on Base, and I was like, this fits better into our mission and our values. Let's do this. And so then we switched over to rETH. And I will say it's been really wonderful to work with the Rocket Pool community. I think Rocket Pool as a protocol is incredible. I think the community around Rocket Pool is also incredible. Putting decentralization first is just incredibly important. And I think we've seen that play out here, over the last 6 to 12 months. And it's become a more important part of the discussion. But yeah, I will say everybody within the Rocket Pool community has been great to work with. I've really enjoyed working with the IMC. I've enjoyed working with you, Jasper, as well as Maverick and some of the other folks in the community. So it's been really great, and I'm really excited for our launch, which is coming up soon, the first phase of our rollout. And I'm really excited to build a primitive that rETH holders can benefit from, and we can help onboard more people to rETH, to a really great decentralized liquid staking token that people can hold, and contribute to a more decentralized representation of liquid staking tokens out there, instead of things like Lido or things like
Right,
Coinbase.
right. So, speaking from my perspective as a member of the IMC, it's been phenomenal to have you guys on board. Great communication, and this is a wonderful partnership. Happy to see it continue into the future. And you mentioned your plans for mainnet, for rolling out. Can you talk a bit about that?
Yeah, absolutely. We're planning the first phase. We're doing a two-phase rollout. So the first phase, we're looking to ship relatively soon. When we do, I plan to give the Rocket Pool community a little alpha, a little heads up before we make a public announcement, if anybody wants to deposit. But we'll have the initial markets capped at 1,000 rETH in the flat money unit market, and then it'll be uh, on the leverage side. Open interest will be capped at no more than 20% above what's in the flat money market. But for that first month, we want to reward early community members, the people that were depositors to the flat money early depositors vaults, to some other early community members who help us with feedback on testnets. So we wanted to give them basically the first month where they can earn yield, and people can get used to the protocol, learn more. And then once we do our first phase, we'll launch the second phase of the full launch, around a month after we do the first phase of the rollout. With that, we'll launch the second phase of our FMP campaign. So our flat money points is what we're using to reward early contributors and early participants in our ecosystem. We have a blog post that kind of covers the different seasons that we're using, but the second season will be for DHT stakers, because flat money is a part of the DHedge family. We work very closely with the DHedge community, and some of the team that's been contributing is also part of the DHedge community. So the second season will be for DHT stakers when they launch their new DHT staking vaults. And then we have other seasons as well that are coming. We haven't announced all of them, but yeah, I think there'll be some seasons that you guys will be happy with in the future.
Sounds like an exciting rollout campaign. Uh, so, how can users earn FMP right now?
Right now, our first season was for the early depositor vaults. Right now, the best way to earn FMP is to participate within the protocol once we do our rollout. So like I said, we'll have incentives, FMP incentives for leverage traders that want to participate on the leverage side of the market. I can say that there will be some incentives for early unit holders, early adopters. We haven't announced exactly what those are, but I can share that off and say that there will be incentives for early unit holders. And then the second season will be for DHT stakers, and we'll have future seasons too, and we'll announce those from season to season, just to keep people on their toes. But yeah, we have some cool things planned in the future as well. So, but yeah, the core way to earn flat money points is to participate in the protocol and participate in the ecosystem.
Very
I'll
nice,
just
very nice.
say, as flat money ramps up, the kind of the deployment and the demand for rETH will increase on base. So what that means, there'll be opportunities to kind of arbitrage it versus mainnet. So I'm sure there'll be opportunities to mint rETH on mainnet, or for rETH holders to bridge down to base. I'll just take advantage of that.
And as the demand for rETH on base continues to grow, and we see its growth in the community, we on the IMC will also take that into account as we, decide on our incentive structures every period.
Awesome.
That sounds great.
So, can you tell me about audits and securities measures you guys have taken for the protocol as you're nearing launch?
Yeah, so there's obviously a few, like, following best practices. DHedge has been around, for a few years now. We've decided to team up with Sherlock to do a big public audit, and there's a second one as well that's just finalizing. So within the protocol, we've taken some measures that other protocols kind of don't necessarily do, in terms of making sure that all the accounting, all the invariants. So for some of the developers here, invariant checks are done on chain within the protocol itself as like an additional security measure. And just as we scale, we'll continue to do continuous audits and improvements there. Anything I've missed, Brave?
I think the only other thing is that as we're working with Sherlock, once we complete this next audit, we're going to try and work with them to get bug bounty coverage in place so we can grow our bug bounty program. When we go to our full launch, we'll have a bug bounty program through Munify, and that's what we're planning. And then with Sherlock's bug bounty coverage, we can increase the amount that we offer for criticals. And if there is a payout, then we'll be covered through Sherlock for that. So that's still in the works, but that is our plan to have that live when we have our full launch as well.
Great to hear it. Great security practices. Rocket Pool also had, a graduated launch in tiers with bug bounty in place and several audits. So it's great to hear you guys are following similar procedures. I'm sure that the rETH holders out there will appreciate that when they check out Flat Money.
Yeah, and if anybody wants to learn more about the protocol security, the Oracle setup, or the risks in the protocol, we have all of that in our documentation as well. So you can take a look and read through those sections. And if anybody has questions, they can drop into our Discord and ask us any. We can clear any questions up that anybody has.
Well, it's been great to. Oh, yep. Go ahead, Ermin. Were you gonna say something?
Oh yeah, I was just going to say, and also on the kind of, if some of these ideas have kind of piqued your interest, definitely check out the Building Better Money series on the blog as well.
Yeah, definitely shout out any other places where users can follow or learn about Flat Money.
Yeah, if you want, you can check us out at flat.money. That is our main site. You can find the blog there as well as our socials. You can also follow us on Twitter. We're OX Flat Money on Twitter. If I can, I'll just drop in the tweet that we have where we have the entire Building Better Money series launched out in that tweet. And you could also find us on Twitter there. So yeah, and then if you would like to join us on the Flat Money Discord, you can also find that on the flat.money site, or you can find that through our Twitter account as well. So yeah, I think we have a lot of great stuff on our blog. So I think that's the best place to get started to learn about Flat Money. You can check out our docs and drop in Discord and ask us any questions.
Well, it's been a pleasure chatting with both of you. I think Flat Money and Rocket Pool share tons in common in terms of principles of decentralization. And, as the IMC and Flat Money partnership has blossomed, I think that's, going to pay dividends in the future. Uh, Looking forward to seeing the mainnet rollout progress. And if you are a rETH user out there, pay attention. You might be able to earn yourself some Flat Money points in the near future. Uh, thank you guys for joining us. Any final comments?
Yeah, I just want to say thanks for having us. It's been great chatting. Happy to share what we're building at Flat Money. And just thank you to the Rocket Pool community for just being so great to work with. Thank you to yourself and the IMC as well. So yeah, again, if anybody has any questions, just drop in Discord or follow up with us on Twitter. So we're happy to talk to anybody that's interested about Flat Money.
Yeah, for sure. Yeah, looking forward to working together. It's been great.
Great. Thanks, chatting, guys. It's been a pleasure. We're going to be transitioning now to the second portion of today's call. You guys are free to hang around if you want to, where we will be talking with Langers, the general manager of the team, about some tokenomics questions.
Hello.
Hey, Langers. Good to hear from you.
Yeah, how are you?
Doing well, doing well. So, I got to say, originally this call, when me and Matt were chatting, was supposed to just be Flat Money, but it's a nice surprise that we have you here today. So thank you for joining us.
That's all right. That's all good. I'm always here, but I live in Discord. But it's no, it is good to jump on. I
A
think
proper Web3
no,
dev.
Mav said that there was some talk around our kind of opinions on the tokenomics and that sort of stuff, and that's kind of fair. We haven't necessarily like done too much of that publicly recently, so I think it probably is a good time for us to talk about that stuff. I think we've been quite cautious, mainly because, well, first of all, we want the community to have a really good discussion without us necessarily throwing away around, and we've definitely been criticized in the past about throwing away around, so that's why we're a little bit more cautious. But I think it's probably good timing to explain what we've been doing in the background in terms of like the tokenomic stuff. Yeah, I mean, I can go into, unless you have any like specific questions, I can go into like what we've been doing so far. Is that cool?
Yeah, let's start with that, and then I do have a list of questions, but let's do some background first.
Yeah, cool. Okay, so so essentially, we've been trying to get our heads around it ourselves. Luckily, Kane and I were on the review board for the incubator process that the GMC ran, which was a fantastic process. I think that's definitely something I think we should probably take forward going forward. So Kane and I were on that, so we had a good understanding of the different proposals, but the rest of the team didn't. So we've been making sure that the rest of the team kind of understand each of the proposals and kind of what they mean and that sort of thing, both technically and so that we can actually provide some feedback back to the authors. We met with Samus and Val, and they took us through each of the proposals, which was really great. I think the team got a lot out of that, and then we kind of provided some feedback back to them on a couple of things, just things that we kind of felt were important to incorporate into the RPIPs. And then quite recently we've been having a chat with NodeSet as well, because obviously they have a kind of a different angle on things as well. So we were having a chat with them as well. So we've been kind of getting different angles. Obviously we have our own kind of like thoughts as well, and we can kind of go into those probably as you go through your questions. We'll shake out that stuff anyway.
Yeah. So let's start with a meta level question, which is, how do you or the team view the different responsibilities with the transition to a new tokenomic structure playing out within the community and the team?
Is this kind of like the roles in the development process, or
Yeah, like
the
the overall progression, like how you see it playing out from this point to the point of launching, and like where the responsibilities lie on the two parties.
Yeah. So obviously, I mean, we were very keen for the community to be driving the idea generation, and to a certain degree. I mean, we have already thrown in some of our ideas into the mix early on anyway, but we were very keen to get the community to drive a lot of the idea phase. That's done in terms of that's well and truly done, and I think the GMC played a fantastic role in that element. We're now into this kind of like refinement. So the idea phase obviously is you go, you open everything up, and everything's open, but then eventually you need to start to come in. and focus in on particular things and define the scope and the vision of what we're actually building. The community are definitely, and so we have been playing a bit of that role in terms of engaging with the authors of the RPIPs and that sort of thing. And we will we'll definitely provide a bit more of that role going forward as well. But it's definitely a co-development process. Like the RPIP authors are doing a great job in terms of rallying the community around different ideas and that sort of thing. And we've obviously had some different feedback from NodeSet and that sort of thing as well. So I think incorporating all of that is good to be able to refine that vision. I think we're probably in that part now, and that's why again I'm keen to engage now, so that we can shake all of that out and make sure that we come up with a really great consistent vision that we're all kind of on board with. So that's the point where we I think are at the moment. Once we are at a point where we've got kind of like sort of a vision, I think we are pretty close to that. We can then go through the voting process and get that kind of ratified, at least kind of sentiment wise. I think I definitely I've had a quick chat with Val this morning kind of about that, but trying to get some sort of vote to get some sentiment around these ideas, and then we can start building essentially. From our perspective, there's one element actually that is in there that is kind of specific to one or two of the proposals. So this is something that has probably come up more in the last few days, and it's something that's been bubbling around with us as well. Is that there's definitely some risk around some of the value capture mechanisms,
right?
Some legal risk, right?
Yeah.
So exactly which way we go in terms of that. And I know that other members of the community are kind of like thinking about this as well. So exactly which way we go, I think we need to get some legal advice on those areas to guide some of that, mainly so that we don't just shoot ourselves in the foot. That's the worst case scenario is we go ahead and then we just shoot ourselves in the foot. So I think it's good to get that process started. We can still vote on sentiment. We can still kind of rank options. We can still do all of that thing up front so that we can hit the ground running. But I think we do need to have this legal kind of assessment going in the background. We already have a plan for that. In actual fact, we've already kicked off that process now. So literally this week though, so it's very early, but we've kind of like kicked off that process. We actually have access to say some of the best minds in this space. So luckily through our connections and that sort of thing. So we're going to kind of talk to them and see whether there are any kind of like obvious no's or things that we can do to make sure that we don't shoot ourselves in the foot.
I mean,
that's okay.
I was just going to bring up that just today Uniswap got a Wells notice that they're being investigated by the SEC.
Yeah,
so I mean, it's a legitimate concern, and I'm glad you bring it up, because that's actually what the chief concern I had in my head when I was asking the question about the responsibility split, and I'm glad that the team has this access to seemingly the top legal minds in the space. That's pretty awesome. Do we have any timeline on when we can expect to hear back for them roughly, how that might fit into the timeline? Because ideally we would have voters be aware of their analysis somewhat before we get that final sentiment polling or final sentiment vote.
Yeah, I mean, I mean, we can still do stuff. My suggestion is that the elements that are kind of under legal review, we just rank for now, rather than decide on a particular angle. At least then we get kind of like an idea of the sentiment around each one. I agree with you that it would be better to have this legal advice up front. I'm not sure how long it's going to take though. We need to engage them, and we've not really engaged them on this level, so we don't know how long it's going to take. It may take no time at all, or it might take a little bit longer. I don't know yet, and it's very, very early. So I'll try and give you a bit more of an idea about that in the next week or so, because as I said, we've only just started engaging them. So I'll try and get a little bit more information about the timing of that. But yeah, worst case scenario, I think we should go with ranking first, and then we can kind of lock down what we do afterwards. But yeah, I'll try and get that done. We'll try and get that done as quickly as possible. Because obviously, yeah, I agree that we need all of the information on the table.
That's great to know. And I expect it will take some time, but definitely going to be worth it to get a solid background for the eventual vote. So on the parts that are not under legal analysis, quote unquote, it seems like we have pretty broad consensus on a lot of Saturn, like the idea of megapools. Although I do have a question about that, given that there's been some concerns recently about the centralization tendency of megapools under the bonding curves. Do you have any opinions on that? It, I think, is de facto true that sublinear bonding favors some degree of centralization. Like how much centralization it favors is not really clear. I personally tend to think it's very minor, given that the curve plateaus essentially after roughly 60 ETH, I think, from Val's model. But yeah, I'm curious how the team has thought about that.
Yeah, that was actually my concern very early on, in terms of having a curve. But the curve is as best as we can do. Everything that we do is trade off between something else. So I think it's the best curve that we could come up with the constraints that we have. The constraints that we have is that we need the 8 ETH or the 2 by 4, the 2 mini pools at 4 ETH, and then it starts to then it degrades. We need to have those two to prevent kind of like EL stealing. So protocol safety tends to trump everything else, so we kind of have to have that. But it's good that it just drops off, because if there was any other slope to the graph, or the slope to the bonding, it's not even a bonding curve, like it's a bonding line. But if there was any slope to it, I would agree that there would be centralization tendencies. But because we drop it off completely, there is kind of like a minimum. Obviously, there is a bit of a jump to get to that point, but then, as I said, then it's available to everybody, equally. So I think that's good. It's not like proof of work where there's economies of scale all the way. It's actually kind of quite flat from there on. But we can see what we can do in terms of lowering that front loaded part. But obviously we have constraints. At least at the moment we have those constraints.
Yeah, I think it is definitely a manageable amount of centralization pressure, and we have a variety of tools to deal with it if it does somehow present itself as an issue. For example, we could flatten the curve even further and cap it at a lower value by simply increasing the commission of the lowest tier pool. So have 5% commission for LEBX, and then once you hit 1.5, it drops down to 3%, or some other or variable commission solution. Point being is there is room to modify the curve to reduce centralization pressures if that becomes an issue. Additionally, node set in theory counteract some of the centralization pressure by giving access to extremely low bond mini pools very quickly for new node operators. So a bit of synergy there, in my opinion. So moving
Yeah,
on. Oh, say something.
yeah. That's right. I was just going to say yes. There's there'll be kind of like a good choose your own adventure there for people who kind of different ways of interacting with Rocket Pool, which would be good.
So the rest of the Saturn tokenomics rework is generally pretty consistent. It's really that question of value capture that has people hung up. And right now there are three splits that are being discussed mainly. You have the give value to RPL burn, give value to LP, give value to voter share. So to elaborate a bit on them, the buy and burn model would take revenue from staking from the protocol, go on to DEX markets, buy that RPL, and then burn it. The LP model would create a limited DEX where single-sided liquidity is added, buy-side liquidity, so to speak, on RPL. This would make RPL more liquid on the markets and provide most of that value capture. However, this starts to get tricky, as well as the next one, direct value capture, in which, or voter share, sorry, it's called, in which RPL stakers receive ETH directly. It it gets tricky in the question of legality of, is that a security or not? But if we take that aside, does the team have any preference between these three on what it thinks is best for RPL's long-term future?
I think the voter share one I need to just double check. Is that RPL holders can lock it in a vault and get
Yes.
the
Yeah, it's a similar. Yeah.
yeah. So I think from our perspective that one's the most risky. um, the mainly from the legal perspective, but again, we're not lawyers, so we're going to leave it up to them to kind of like assess that. RPL burn seemed better to us, mainly because it's not direct, and I quite like RPL burn because we move away from locking up RPL. So actually, both RPL burn and LP, I quite like those two mainly because we get them away from locking up RPL. Well, obviously, it's still going to be locked up in RPL voting nodes, but we don't. We get away from locking up all RPL. You know what I mean? Which I think is a cause of some issue, and that is particularly around like liquidity and that sort of thing. So RPL burn, I quite like that for that case, and obviously RPL burn is an easy sell from a narrative perspective. The ultrasound RPL has that's quite an easy thing to sell, but I'm actually coming around to the LP idea because it solves kind of like two problems. It provides good access to RPL. It provides good kind of like price stability. There's quite a lot of things I quite like about it. I do think it's a little bit complicated, but then again, I don't know. Everything is slightly complicated. So there are kind of like thoughts on it at the moment. Again, it really depends on like the legal stuff that comes back.
Focusing just on the buy and burn and then LP, just throwing out some of the discussion that's been going on around them. Some of the issues around buy and burn might be potential for value leakage. I believe it was Long for Wisdom, who was the former MKR DAO member, commented about how MKR, which used buy and burn, saw varying degrees of success with the buy and burn. While they were able to burn it, MKR, they found that it was a low impact amount relative to the daily flow of MKR. Further, MKR also suffered from users being able to front run the MKR transaction or sales, leading to value loss for the protocol. It's not clear that these pitfalls would also affect Rocket Pool, given that it is possible that the RPL volume is low enough such that buy and burn actually will have a significant effect on order flow to provide value to, provide a floor to the value of RPL. And further, we can learn the lesson from the lessons of MKR to design a better buy and burn, given that there are also now new methods to do that. So if we were willing to, work with a cow swap or our MEV protected route with LPs and some of the actually let's just start with that. What are your thoughts around some of those concerns and responses for buy and burn?
I think that's fair. Like there is a my thoughts about buy and burn, there is a risk on the benefit side. So yeah, there's kind of like a risk on the benefit side, whether it's actually going to benefit us.
Yeah.
As much as we hope. It is kind of more of like a suck it and see type thing, which is not necessarily where you want to go. I think it's attractive because it's an easy kind of like sell to the market, but I don't know how much benefit. Yeah, it's difficult to tell how much benefit we're going to get out of it. The LP is much more not direct, but there's it fills a particular need. Whether it still drives demand or not either as well, I'm not 100% sure. Like providing LP is good because then you have liquidity available to the market, but then do you have demand? Now I guess that's what buy and burn tries to do is it creates this continual demand.
Sounds good.
Mm-hmm. That and it is all. I don't have answers to those questions.
Yeah, no, I'm just curious to hear your thoughts around just the discourse that's happening so far. Is it still fairly early, given that we don't have proper analysis on how these proposals would impact these three specific value captures would play out, and I think that's something that would be very useful for the community, like to have concrete way to compare between buy and burn and LP, especially given LP is somewhat complex to reason about, given that as you described, it's not quite induced demand, but it is protected selling.
Yes, that's right. Yeah.
Some other benefits or potential complications of the LP model is while there would not really be a third party dependency, it would add a good amount of complexity because the protocol would have to also maintain essentially a DEX for rETH. And while it's true that we already kind of do with the deposit pool, this would be a much more complicated apparatus.
Yeah. The other kind of thing that we were talking about, actually, I should probably reference Samus first. So Samus has mentioned in the chat that voter share is only node operators with RPL staked, not pure RPL holders staking it. So that is definitely a different. That's different. Well, I think that's different in the laws, in the legal position. But I'm not 100% sure. No, it should be ideally. And so it's essentially voter share would be more. It would be more ETH to what is vote eligible nodes. I think that's what Samus is saying there.
Yeah, similar to like the current system more.
Yes. Yeah. Cool. Because the other thing that we've kind of spoken about potentially is opening up RPL staking to not just RPL. Yeah, cool. Yeah. So not just so opening up the potential for like LP tokens, RPL LP tokens to be staked. This is something that was mentioned by a few people quite a few months ago. Now,
Tim Jansen from Balancer had a very good
yeah. So he doesn't. Yeah, he's not with Balancer now, but he was then.
Right.
So we've always been kind of like against that idea, mainly because again, we don't want the dependency, but in that particular case, it might be acceptable, because in that scenario where you're using it as vote weight, actually it probably might make it worse. So where it's not being used as a collateral, that it's being kind of like used as vote weight. If, for example, Balancer had an issue, obviously it would affect the vote weight, but it wouldn't affect protocol safety as such. It would obviously affect those individual node operators, but it wouldn't necessarily affect the protocol. Although in saying that, as I say it would affect the fact that a huge portion of our vote weight would disappear. So that wouldn't be ideal either. So we're kind of like bouncing around ideas like that as well, because in that way we can still get the benefit of like this LP, but we get the benefit of having liquidity, but they can still kind of like stake it within the protocol and benefit from the ETH rewards and that sort of thing as well. So we're just kind of like having a think about those sorts of things as well, just to see whether we still like it. I think we still dislike the dependency, but that's something we've been thinking about.
So that would kind of look like a combined version of voter share and LP model, whereby if you follow the Val's version, you would fork the weighted pool, and then have that as the accepted collateral token, which is a pretty nifty idea, and I would like to see that explored more. I think Tim back in the day suggested like an 80-20 pool, or like a very low volatility token, which like an 80-20 pool is 1/5 the volatility of the underlying. So even if RPL has massive swings, the token is pretty succinct. The One of the issues becomes if you use an ossified, in the ideal world, forked version of the balancer pools, and then one day there is a bug, like we have to have safeguards there, so that we can migrate from the bugged pools into the safe pools. It is a level of complexity, we have to have safeguards around, even though it's not quite a third party dependency. It's always better to have tool. Well, maybe not true, but it seems better to me to have tools be built in house. So, question coming in from Ken: On the topic of legal counsel, should there be any GMC budget provided for this, or is this something that the team feels that they can cover?
We'll assess that. I don't believe so. It really depends on how we engage them. At the moment, we're engaging them informally. If they need to do significant work to kind of like do this for us, then we might have to engage them formally. In which case, we'll assess how much that's going to cost, and then either we'll bear it, or we will kind of like wave a hand at the GMC to kind of like help out. I don't know what that is yet, so we'll determine that and then see whether that's something that you guys can help with or not.
Got it. Yeah. So I'm sure the GMC is always going to be ready to step in if necessary. Question coming in from. Mhm.
Oh, sorry. Just before we get to that question, one thing that popped into my head was, in terms of like UVC and splitting up the commission. One thing that has become apparent, obviously recently, with restaking kind of like sucking the air out of the room slightly, is provision for rETH stimulation, rETH demand stimulation. I'm pretty sure that Val mentioned that within UVC there is a switch that we can turn on to help to steer a little bit to the PDAL or something like that for other things. I think rETH demand stimulation might be one of those things.
I believe Val wrote about how that PDAL could essentially just be to turbocharge the rETH growth as well. Yeah, it makes sense for there to be a provision in UVC to go the opposite direction. I would hope any eventual implementation had that. We have a question coming in from Samus. Would legal analysis be published publicly if it was provided?
Sorry that I don't have answers to that yet. Until we engage them, until we kind of like, until we've engaged them properly, I don't know. I don't know whether they're comfortable sharing that legal advice publicly or not. Obviously, we will, but by what we say, we have to give you details. We have to give you an outcome of the legal analysis to be able to steer decision making, and we have to give you enough detail that you you guys think we're not just making this stuff up. So ideally I would like it to be published publicly, but I don't know whether they will be comfortable with everything being published or not. We haven't engaged them on that yet.
Yeah, that makes sense. It's hard to just comment on legal issues without knowing any of the legal issues themselves yet. So a couple questions coming in from Valdorf. Is Kane free from Houston? I guess this is in reference to being able to start working on megapools, which is the follow-up question. How's megapools going?
So the answer to that is not. Well, we've been doing actually. So he's been doing one last bit. So he's just been setting up like the DevNet for this testing of the transition. But we've also had Max EB to kind of like be dealing with as well. So Kane and I have been dealing with Max EB. Actually, to be honest, it's actually probably going to be Fornax and Kane on megapools. So they will both be working on it very, very soon. But I think Kane is now finished the deploying the DevNet. I think there's tiny few bits today. I think he'd be kind of ready from tomorrow to start back on megapools, at least getting back across it and getting Fornax up to speed. So yeah, so we're hoping to start that very soon.
What would you say the rough timeline looks like for the next couple of months of mega pools building, tokenomics discussion, and RPIPs?
Yeah. So so I think governance and development will happen in parallel. As you kind of said, megapools seems almost universally accepted. So it looks universally accepted. Megapools is by far the biggest element of, so everything that's being proposed at the moment, at least. Megapools is by far the biggest piece. So we can busy ourselves with megapools and get those. We've got a prototype for megapools at the moment, but it's a prototype. So there's a big difference between a prototype and productionized code. So what we're going to be doing is picking that prototype back up, and basically making it robust, kind of going forward. So we should be able to hit the ground running because we have that prototype. But there's still quite a reasonable amount of work to do on that as well. The other thing, actually, the reason why MaxEB has, well, MaxEB, which is increasing the max effective balance EIP from Ethereum. There's two reasons why that's actually very important for us to deal with today now. The first reason is that the core devs are asking for our feedback on it because they want to incorporate it into the next hard fork, and that the timeline for that is very, very, very close. So, well, in terms of like getting them dev complete and all of that sort of thing. So we've been providing that feedback to make sure that MaxEB essentially isn't going to screw us. Then the other aspect to it is MaxEB actually affects the megapool design, because with MaxEB you can have, so at the moment the minimum and maximum for validated balance is 32 ETH. So that your effective balance is 32 ETH, and you earn yield on that 32 ETH, and the max you can deposit, or at least the max you can earn money, earn yield on is 32 ETH. With MaxEB, they're increasing that, so you can keep depositing, or your rewards can keep compounding, and you will earn more on that, up to 2048 ETH. So essentially what we've got there is each validator will no longer have a maximum of 32. It'll actually have a maximum of 2048. So, and the design that they've got so far, we have to be a little bit careful with the megapool design, because actually doing this whole thing where we have multiple validators, that might actually not be a good thing going forward. But with MaxEB, it actually doesn't matter, because with MaxEB we can actually just have megapools tied to one validator still, but it'll go all the way up to 2048. So and we'll still get all the benefits of that, but we'll just basically have these much larger mini pools essentially. So that's something that we're looking at the moment, because they're very, very keen on getting MaxEB into the next hard fork. So we just have to kind of be mindful of that and mindful of the design of megapools.
On that topic, I saw today that they were talking about Nixo shared if they should have custom caps, or like if you should be able to set how much you will compound to, and something like that. And then additionally, somewhat relatedly, there's also been discussion about execution layer initiated consolidation, which would really change the game for Rocket Pool. So exciting to see that evolve.
Well, okay, so
Or
yeah,
not?
well, I had the conversation the other night. So custom ceilings, there was a bit of a kind of like meh response to custom
Yeah.
ceilings. So that and that's fine. I mean, I don't see that necessarily being a huge issue for us. So at the moment, consolidations are at the consensus layer level, which is a bit annoying for us because that's essentially out of protocol or out of Rocket Pool protocol, but still in Ethereum protocol. And there was a big push from Lido, and we looked at it as well. We would kind of prefer execution layer consolidations. Sorry, I should say consolidations. Consolidations is where they want people to. The idea of MaxEB is to be able to consolidate as many validators as possible. The reason why they want to do that is because each validator it takes up network bandwidth, right? It takes up the gossip network bandwidth, and so it's actually quite inefficient in that way because it just basically causes stress on the gossip network. So they're very keen to have this in there so that large stakers will consolidate their validators into essentially these mega 2048 validators, and so you have less network traffic on the gossip network. Now, that's what a consolidation is taking two validators and not smashing them together. It's the wrong way, but basically transferring the balance from one validator to the other to consolidate them all into one validator, right? So this enables, like for example, this enables Lido to consolidate all their validators under a few validators rather than the thousands and thousands that they have at the moment. Now for Rocket Pool, so there are a constraint with consolidations. Consolidations have to be against the same withdrawal credential. So if you've got two validators connected to the same withdrawal credential, then you can consolidate them. If they have different withdrawal credentials, you can't consolidate them. So for Rocket Pool, for example, it doesn't really help us, or at least we're not gonna contribute much to the consolidation effort for two reasons. The first reason is Rocket Pool has a median number of validators of like 2, so we're not going to help too much there. Obviously, the larger players they could potentially consolidate, but the smaller ones are not. The other reason is that we're 1-to-1. Basically, we have every mini pool, which is a withdrawal credential, is mapped to one validator. So again, it doesn't help us there because we can't really consolidate our mini pools that way. The concern, there is a slight concern around somebody could, for example, create a validator that has the same withdrawal credential as one of our mini pools, and then they could consolidate it to their validator. The thing with that is though, they would be gifting rETH holders 16 ETH. Funds would be safe, but the kind of some of our metadata would be wrong because the mini pool would be pointing at the actual validator would be pointing at a different place. So that would be really annoying for us. But it would cost the attacker or griefer, whatever you want to call them, or griefer actually. It would cost them 16 ETH to do it. So it's unlikely that somebody would ever want to do that. So that's probably the only key thing that we spotted that it could be a problem. They did suggest execution layer initiated consolidations instead of consensus layer initiated consolidations. But the problem there is that the core devs really don't want to do that, mainly because the timelines that they're talking about is that they want to get this stuff onto a DevNet next month. So they don't they don't want to spend time basically doing that if it's not necessary. Both Lido and us said that we would prefer execution layer initiated consolidations because it makes much more sense for us, but we are safe. I think our funds are safe if it went the other way as well. So that was where the conversation was at the moment. They're still getting industry feedback. I think there's another meeting next week, so we can still provide feedback, and other staking pools are being reached out to provide feedback. But that's where we are at the moment. One of the core devs did mention withdrawal credential consolidation. That would be enormously beneficial for us, because we would then have a migration path to megapools. The issue there is that it got dismissed quite quickly, so I don't think that's going to happen. But it was something that was raised, made me very excited, but then it was quashed quite quickly.
Yeah, honestly, in the perspective of the core devs, we're a fairly insignificant percent of the staking share, and our consolidations would have very minimal effect on the peer-to-peer network itself. So if they're facing short timelines, it makes sense that our wants are going to be subject to some backseat placement.
Yeah, I'll definitely. I'm still gonna mention it. I'll do a little bit of back channeling and mention it to them that we could really, yeah, even so, like the median, as I said, the median number of our we wouldn't justify it necessarily. Wouldn't justify the amount of effort to kind of like do that. But I can mention it to them as that's something that would enable us to consolidate more than what we're doing at the moment. But yeah.
Question coming in from Ken, asking you to clarify a previous comment. Is it correct that you said, so a megapool is not a smart contract that supports multiple validators, but rather a smart contract that supports one max EB validator up to 2048 ETH?
Yeah, so this is still very early, right? Because we're just seeing how we would handle max EB going live. If that's the case, if it's going ahead as it is at the moment, I think yes, it would actually be a smart contract that handles the 2048, essentially one max EB validator. The reason why I say that is because if we try to manage multiple, that comes back to, that's the reason why I was also talking to them about this execution layer initiated consolidations, because if it's consensus layer, that causes it may cause issues with megapools if it's more than one validator. We need to reassess. We need to assess that to make sure that that's valid. But now we have an idea about what max EB looks like. We can review that. But that's something that we're kind of like looking at. I mean, the majority with the max EB validator would fix the majority of our problems. The larger players would still have to have multiple mini pools, but obviously it's on a much larger scale. Like they can go up to 2048 ETH per thing. So it's much easier from that perspective, in terms of managing all those validators rather than having individuals. One of the obvious questions is, why don't we just build it into the mini pool stuff? And that design decision will depend on some of the proposals that we've got, the RPIPs. One of the proposals is around changing the upgrade system. As a team, we really want to get rid of rollback. We like opt-in roll forwards in terms of, and this is in terms of like mini pool delegates, upgrading your mini pools. We like the opt-in roll forward, but rollback is a real pain from like a security and development perspective. So we really want to get rid of rollback, but it's built into the current mini pool structure. So we kind of almost need to have a separate thing to be able to get rid of that. We need kind of like a mega pool thing rather than a mini pool thing. So that's definitely something. And there is a proposal to even remove opt-in roll forwards, although we've provided feedback on the fact that although we agree in some principle to that, we still want people to be able to choose to roll forward at a time of their choosing rather than being forced to do it all in one go. So that's their considerations that we're considering at the moment.
Yeah, I think there's a lot of value in the opt-in roll forward. Users might feel rugged if they are suddenly obligated to upgrade to a system that they don't agree to. Even though one might say that they have the option now to exit, it's still somewhat of a coercive incentive.
The other aspect that we put forward was also just from a security perspective. If you upgrade everyone all in one go and there's an issue, you've just upgraded everyone. So from a peace of mind from our perspective, we like the idea of people opting in and rolling forward. So actually, the thing that we've suggested is that that there's kind of like a period where people can opt in at their own will, but then there's like a cut-off period where we then force everyone to move forward, and so that gives them time. It gives them time to exit if they don't like the changes that are incoming, but it gets the benefit of being able to upgrade everyone and move them forward. But also it provides this kind of like buffer to make sure that there's no issues and that sort of thing. So that's kind of like I think that's the approach that we've suggested for that particular one.
Got it. So a few more questions coming in from Samus. What do you think is the technical feasibility like for the various proposals? Do they all seem feasible, or are they of varying degrees?
Sorry, say again.
What do you think is the technical feasibility of the three types of value capture? Do you find them all feasible, or is one or are any like seemingly out of scope?
No, all are feasible. So I think increased voter share, that's all kind of built into UVC anyway, I believe. The buy and burn is relatively simple, I would say. I should put a caveat on. All of these look conceptually simple on the outside. As we start to, dive into them, there might be some hidden complexity. But from just from where we are at the moment, buy and burn is actually pretty simple to implement. LP deposits, I think there's some complexity in like how the pool is structured. I don't necessarily see it as a huge issue, but as I think as we said before, there's complexity in the LP one around like safeguarding the third party, safeguarding the third party element. So yeah, what do we do if the pool is under risk, under threat or something like that? We need to essentially migrate our liquidity, or how to. That's probably the complicated bit on that. I would say buy and burn at a high level is probably so. Increased voter share is the simplest because it's built in. It should be built into UVC anyway. Buy and burn is not much more difficult. And then LP deposits are probably the more complicated one because we have to deal with like safeguarding the third party and that sort of thing.
Yeah, that all makes sense. So there's been discussion about how this overhaul to Rocket Pool will roll out, in the sense that will there be one major upgrade, or will there be two iterations of the overhaul? So do you have any ideas around this? And if you think that it should be split up, what components do you think make sense to go together, and what should be uh, delayed into Saturn II potentially?
So I think there's going to be at least 2 releases. There could be 3, but I think there's at least 2. It makes and some of it is going to depend. Some of it is going to depend on timing. It depends a little bit on when. I think is it Electra, Pectra, Electra.
Yeah, Pectra.
Yeah, Pectra. Some of it really depends on Pectra. Some of it depends on. Or maybe it's good. We probably shouldn't tie ourselves to Lido CSM, but maybe it's a little bit influenced by Lido CSM. My initial thoughts at the moment is that Megapause is kind of like a definite. The upgrade changes is makes sense to go in at that point as well. UVC makes sense to go in with Megapools. UVC makes sense as well to go in. I think the only issue is whether the value capture thing goes into that first release, and I think to do ETH only mini pools, I think you need that value capture mechanism in that first release. So I think my preference has moved around a bit, to be honest, but I think my current thoughts are that it should probably go into the first release, because if it goes into a second release, then you're kind of like.
Sorry, could you specify what you're talking about? What should be going to the first release?
The value capture mechanism. Something like buy and burn. I think because if you push it into a second release, so really you have to have that all in one in the first release. If you push it into the second release, essentially you're doing ETH only mini pools without changing the nature of RPL, which I'm not sure whether that's a good thing or not. But then the next release after that, I think, is the bonding curves and that sort of thing. But the reason why I say it depends on, I'd like to break it up a little bit, as much as possible, because I don't like the idea of having such a massive scope of release, mainly from an audit perspective. The more there is to audit, you're spreading yourself thin in terms of review and that sort of thing. So I like tighter scopes, but at the same time, we need to be able to deliver something that is cohesive from a product perspective, and mainly from a product perspective. The other thing is we also don't want to avoid rework too much. Megapause is kind of like a whole new thing. It's a new space to open up. So you might as well do the new thing in the new space. So that's, otherwise you've kind of got to do some rework to do it the old way initially and then move to the new way. We're going to be doing some of that kind of analysis as we start getting back into Megapause.
That all definitely tracks with me. I think for the initial release, having the ETH only pools is, along with mega pools, are the two killer features that have to be there. And then with that, a limited form of UVC / value capture doesn't have to be the fully robust version of them. which could follow and later upgrades. But having basic versions of them for that initial release makes sense to me. So moving on to another one of Samus's questions, how is the team prioritizing time currently between preparation for Houston Saturn, and then how do you find the current RPIPs?
So in terms of kind of like capacity and time management, as I said, we had this kind of like go no go decision meeting last week, and we kind of felt that we needed to practice the transition on our DevNet, or on a new DevNet actually, just to make sure that, because that was we'd kind of done it, but we'd already also made changes after the fact, so we wanted to kind of just make sure that that process was okay. So that's a little bit of additional work that we had, but to be honest, Kane's is actually to help deploy the DevNet, so that he can then be kind of freed up after that. So yeah, we're kind of like managing in the sense that we've got the Houston stuff is starting to actually it's dropping off completely. There's definitely, so other team members are working on Houston stuff, like Nick's working on a lot of the UI elements, some of the new UI elements and that sort of thing. Although that's starting to come together really well now. We've got Thomas is doing he's doing kind of like ad hoc testing and also documentation. He's also been writing smart node code, which is fantastic to see, and getting kind of like upskilled by Joe and Fornax, which is really good to see. So he's hitting the ground running really well. Yeah, so there's I would say the Houston stuff is now dropping off quite well, and that we can start phasing in Saturn. As I said, we'll be phasing in Saturn this week.
Awesome.
We are. I mean, I've been doing Saturn stuff, kind of like in the background, but obviously this Max EB thing was a bit of another curveball, but we're kind of like rolling with that as well.
I think my final question for you here is, what gaps do you see in the current proposal so far? Do you think there is anything missing from the RPIPs? / what ideas do we need to spend more time thinking through? Coming from Samus.
We might. There's some things around, just things off the top of my head. ETH only mini pools. This is kind of a bit more of an implementation details. It's not, but what we do with ETH only mini pools in terms of phasing, whether we phase them in or just have them free open, or that sort of thing. I think some of that's going to be interesting because we don't know what the demand. We need to obviously kind of match demand on the rETH side as well. So I think that's definitely something that we should have a provision for, is phasing in ETH only mini pools. Obviously we've already mentioned the legal aspects of the value capture ones, so that's something that we'll kind of be involved in and drive from our side. Apart from that, I think that the split on UVC, I think that we have kind of ideas around that, but I think that's okay. What else? I think we've been refining. I think we've been refining quite well as we go along. We'll do more actually, mainly because I've been dealing with this Max EB thing, but we were meant to do another workshop for Saturn this week, but I'll try and fit in another workshop for Saturn this week so that we can again either provide some more feedback or do some more workshopping on that. But yeah, I know. I think it's good. I think we've been refining quite well. We've been obviously giving feedback, and there's stuff in train. So no, I think it's good.
That is awesome. Yeah. Actually, one final question coming in from Ken, a clarification question. Are bonding curves tied to megapools, or are megapools possibly distinct?
Bonding curves need megapools. With max EB, does that change that? I'm not sure. I don't think so. But as far as I'm aware, bonding curves need megapools, but megapools and bonding curves don't need to be released at the same time. So you can do megapools and then you could do bonding curves after. Although that is probably something to think about. It is definitely something to think. It's something to think about.
It's somewhat useful to keep bonding curves in the back pocket because it's a future carrot to encourage upgrading. Because mega pools themselves offer distinct advantages through auto compounding that in theory should be enough of a carrot to attract people to upgrade. So yeah, it doesn't seem like a too bad of a situation if that gets tiered out into the future.
Well, so mega pools would probably have LEB4s as well. I think that's the plan. So you'd have LEB4s and compounding, and obviously for kind of like larger node operators, the efficiency gains from only having to interact with one smart contract rather than several hundred or something like that.
Very exciting. Well, I think that brings us to the end of the questions. It's been awesome to engage on the tokenomics discussion. It's very timely, and there's a lot going into not just the value capture, but the legal apparatus around this and how the community can get best help provide the ultimate product. So this has been very helpful, I'm sure, for the community, and I'm looking forward to the next steps.
Cool. Yeah, me too. Actually, yeah. No, it's been good. I've enjoyed this kind of process, and I'm pretty excited for the future. So, yeah, awesome.
All right, everyone, thanks for listening in, and catch us next time. I believe we'll be doing a call next Tuesday. Mav can chime in if he's here with us. But yeah, thanks for listening.